Welcome, everybody, to Mr. Keith's Money Monday. It is not Monday, it is Thursday, July 10th. This is a special edition. We have two positions that are in the money, so we need to roll what's called rolling a put credit spread down and out. So, disclaimer, understand this is journey on my account, not advice for you guys. Um, this is a learning opportunity to see what could happen when your put credit spreads go in the money and they don't go the way you want them to go. So you can follow along in a paper trade account. You can see what I do here, and you'll know some different tools in your tool belt to work with. So the two positions that I'm looking at is Halliburton and Verizon. We did some put credit spreads on this. On Halliburton, we got 31 cents per contract, and we did 3 contracts. Verizon, I got paid 48 cents for 48 bucks per contract, and I did 2 there. And you can see the Verizon one, I did a 45-40 spread, and the Halliburton, I did a 35-32. So coming back to those, looking at Halliburton first of all, we can see the stock chart here of what's happened. Came up, nice head and shoulders pattern, and it dropped. Usually, if you look up head and shoulders pattern, what the amount it falls, we'll go like 43, 44 here is the high. The neckline's 38, 39, so about a 5-point drop. So usually you can go about 5 points from here. So if you go 38, I don't know where you want to call the bottom, 38, 39, you drop 5 points, that gets you down to 34. So right in this range here. Came down here. So it could find a bottom. You can see this is where it found support before, and it could go up. So I do want to own this company, and the reason I like owning this company is looking at the metrics down here. PE ratios 18.9. I like that. Under 20 is excellent. Forward PE is only 11. That means they expect earnings to go up. A PEG ratio, anytime you have a PEG ratio under 1, it means they've got good growth potential going that way. EV over EBITDA is another thing I look at. Anything under 10, I like there. Return on equity, 15%. That's about average. Debt to equity, under 1, like that also. Payout ratio for their dividend is below 50%, so anything below 75% I like. That way, if earnings do drop, they still have a cushion there to pay the dividend, so they're not going to cut the dividend. So I like this company, and I was willing to buy it at 35, so I'm going to leave one of my contracts out there, and I'm only going to roll 2 of them. So we have 3 contracts. You can see right here the stock price is down to 34.21. We're in this Bermuda Triangle of our put credit spread. You can see this triangle right here. If I put this cursor right here, see the nice triangle right there to the left? That's a Bermuda Triangle. Nothing good can happen there. So this one, 90 bucks was the most we could make if it stayed above 35. And it could get there. It's been flirting up there. So it could, by next week, it could get up there and we'd be fine. But it could drop also down. And we don't want to lose $810. So what I'm going to do is roll this out. Again, this is a stock I'm interested in buying, so I'm going to roll it down just a buck, and I'm going to roll it out. So this is what I'm going to do. Usually I do this in my account, so I'm figuring out how to do it here. All right. So I'm highlighting those 2, and I'm going to create a rolling order. Nope, that didn't do it. Delete that. Click, go there, create rolling order. It's only clicking one of them here. There we go. Create rolling order. So create rolling order for Halliburton. All right. So as I said, I only want to do 2 of them because I'm going to leave one of them. So if it stays below the 35 bucks by next Friday, I'm going to buy 100 shares, which is what I want to do anyway. So the other 2, since I don't have enough money in the account to buy all 300 shares, I'm going to roll out the other 2. So we have the 35.30. This is what we originally did. I am selling. Let's see, what is this doing? Oh, down here, 35.32. So I am buying back the 35 one. So originally we sold it for the $35 strike. So I'm buying that one back to close. I am selling the 32 that we had bought. Then I'm going to go up here and I'm just going to go out to August 21st. I'm going to go out a month and I'm going to roll this down to 34. You could keep it 35 if you think it's going to go above 35, but we're going to go down a buck here. So I went 34 and I went 30. So there you have it. We are closing this one out. So buying back this one, selling this one back, and then going back and selling a 34.30 spread, which would be its own credit spread by itself. And all together, we get $9. In my live account, I got 18. So I'm going to put 10, see if we can get filled there as a credit. Let's see. I'll leave it at 10. Let's see if we can analyze that trade. If I take out the others here. Woo, that created a funky risk graph. Oh, because it doesn't have the others in. So now we're shifting it down to 34. We'll have a new spread there. That doesn't quite look right. I don't know what that is. All right. But this is rolling it down and out. So we went down in strike price. We just went down a buck. And we went out to August 1st. Now I did increase the spread. It was a $3 spread. Now we're going to have a $4 spread. But again, this is stock I want to buy. So if it stays down there, I'll probably buy some more in a month or so. So I'm going to confirm and send that. Let's see this roll. We're going to get $14 credit, and it's going to increase our buying effect by $185 because we're going another dollar down for the spread from $3 to $4. So let's send that in, and we'll see if that one gets filled. The other one we have is Verizon. Now Verizon, let's see if I can pull this back up here. Same thing. The stock price, you can see the chart here, broke support. This is where we were thinking it wasn't going to go below 45. Hammered down here. It's all the way down. It came down to 40.72. It's kind of coming back up. It's at 42.15 right now. Most likely won't get back up to 45 by next week. So what we're going to do here is roll this one down and out. It's dropped a little farther than our 45 spot, our strike price. So it's going to cost us a little bit more. It's going to be harder to recoup all our money. In the Halliburton trade, we were able to recoup all our money and actually make a little money on that one. This one's going to cost us. Now, if you wanted to own the shares, you could just leave it and you could buy it at 45. But when it's down here, I like to buy it when it's below 40. The last time I bought Verizon was when it was below 40. I bought some out here and some over here is when I've bought Verizon in the past. So I like it when it's below 40. Now, if you think that the whole reason this has dropped, I believe, is because they think Starlink is going to come out with their own phone and take away business from Verizon, T-Mobile, and AT&T. If you believe that's going to happen, then I would just close this out, take your loss, and move on and never touch Verizon again. I'm not sure that's going to happen with Starlink. It could in the future, but I'm going to still look to buy this stock, so I'm going to roll this out. If I were to do a put credit spread right now, I'd probably do a 40-35 spread, just because that's where the support and level is back here, and I've always bought it below 40, so I'm going to pretend like I'm doing a brand new one, and I'm going to do a 40-35, and I'm just going to roll this 45-40 down. So going in here, you can see the stock prices here. You can see our Bermuda Triangle. We are way, way past here, and we only got a week left in this. Probably should have rolled this out a couple weeks ago, but I was in Oklahoma and didn't have time to do this, so just kind of was watching it to see. So we're going to roll this down and out. All right. So I'm going to click on this one and this one. So that is our spread. Create rolling order. I only did one again. Here we go. Come on. Click both. Okay, there we go. Finally. Create rolling order. Oh, I got the wrong thing. There we go. All right. So we got down here, we got the one that we have for next week, the expiring, the 4540. Well, we got 40 some bucks for that, something like that. If we go all the way out, I'm going to go farther out. And of course, the farther you go out, the more time you're buying, and the more you can get. So the last one I went to August for Halliburton. This one I'm going to go out to September. Now we run the risk that they have earnings and things really go to pot and it doesn't work out. But we're going to see. I'm going to go down. So I am closing this one out, the 4540. So I'm buying that back, selling that back. I'm going to change this to 40. And I'm going to change this to 35. So it's going to cost me 198 bucks per contract. And we got only 40 some dollars when we did it. So it's going to cost us 150 bucks about per contract. So it's a $300 loss. So hopefully in September, this is above 40 and we can go in and sell another put credit spread and kind of make our money back slowly. If we can make it back in 2-3 months, 2-3 trades, that'll be fine. Now again, if you just wanted to rip this band-aid off, it would cost you several hundred bucks. But we're going to do a rolling down and out. You can agree with that, you can not, you can do what you want if you're doing this trade. All right, so it's going to cost me $198 debit. Confirm and send that. And oh, and there my smoke alarm went off. All right, so there you have it. Have a good day. Talk to you later.